This roadshow is brought to you by ResearchBytes.com.
Welcome to Motilal Oswal Financial Services earnings update for first quarter FY17. Hi, I'm Samir Kamath, Group CFO for Motilal Oswal. During the course of this presentation, I will be taking you through the key highlights on our performance for first quarter FY17. I will also be covering the business-wise updates, which will provide you clarity on the various initiatives we have been taking across our business lines on helping the group deliver a sustainable 20% plus ROE. Coming to the highlights for this quarter, we have been able to deliver a strong quarter in terms of financial performance. Our revenues were 3.7 billion, up 72% year-on-year, and PAT was 0.8 billion, up 179% year-on-year. Our margins expanded to 22% in this quarter versus 13% a year back. ROE was 22%, in line with our strategy to deliver 20% plus ROE. The reported ROE does not include the unrealized gain on our commitment to mutual funds, which was rupees 1.8 billion in this quarter. All operating indicators were positive for this quarter. Broking market share was up to 2.4%. AUM for asset management business was up 58% year-on-year. Wealth AUM was up 54% year-on-year. Aspire loan book was up 4.5x year-on-year. Coming to segment-wise results, the year-on-year growth in revenues is largely driven by scale-up of asset management and housing finance revenues. Investments made in capital markets business have also shown results with year-on-year growth in revenues. The journey of diversifying our businesses beyond capital markets is bearing fruit. Capital markets business now contributed 41% of revenues compared to 57% a year back. Housing finance contributed 27% of revenues this quarter compared to only 10% a year back. In terms of profits, we are now seeing meaningful contribution from newer businesses which were earlier in build mode. Asset management business contributed 26% this quarter versus 14% in FY15. Housing finance business contributed 16% for this quarter versus only 2% in FY15. Fund-based businesses contributed 23% in this quarter versus 13% in FY15. Thus, the dependence on capital markets business, which contributed 71% of profits in FY15, is down to 35% in this quarter. Coming to now business-wise updates. The journey of Motilal Oswal can be broken down into three phases. The pre-2007 phase, which also coincided with the bull run. We were able to establish a strong research-based positioning in both retail and institutional broking, which helped deliver strong competitive positioning and 10x growth in profits. The post-Lehman era in 2008 was marked by consolidation in the markets. We began the journey of diversification by leveraging on our competence of research and relationships in seeding new businesses like private equity, asset management, and investment banking. Headwinds in the main broking business and investment phase for newer businesses resulted in flattish profits for many years, although margins remained steady given the unique all-seasons business model created in broking. ROE was also low during this period. The fruits of these investments were seen post-2013, where we were able to establish a strong competitive positioning in each of the newer businesses and establish a clear right to win. We also deployed free cash flows generated from agency businesses into building a high-quality housing finance business and sponsor commitments to back our time-tested investment philosophy, which we believe will give a sustainable 20% plus ROE. We have been making consistent investments in the broking business to capitalize on the huge business potential that exists within this space. The upfront investments that we made in 2014 is bearing fruit with market share gains from 1.8% a year back to 2.4% in this quarter. We also saw operating leverage kick in into this business with PAT growth of 22% on a revenue growth of 15% year on year. In retail broking, investments on digital initiatives, strengthening of advisory base, and developing asset-based product distribution approach help garner market share and scale. We won the Best National Broker for the 5th time and also best institution for financial education and inclusion. In institutional broking, we saw growth in client empanelment, innovative research products, strong block execution, and ramped up corporate access, which helped us build good traction in this space. Our investment banking business has seen good traction on top line and bottom line. The ECM business has been gaining momentum and saw renewed activity in this quarter. We remain hopeful of the business prospects in this segment. Our strong investment philosophy of QGLP and delivered performance helped build considerable scale in the asset management business. Despite general slowdown in net flows, we have been seeing meaningful flows in our PMS and mutual fund schemes. Our AUM is up 1.7 times year on year. Our market share in mutual fund AUM is 1.3%, whereas our market share of net flows is much higher at 4%, which shows the immense potential to build meaningful scale in this business. Our private equity business manages 2 schemes in growth capital and 3 schemes in real estate. We have been able to build meaningful scale in this business through successive fundraisers of higher size with participation of large institutional investors. Our first growth fund is likely to fully exit its investments between FY17 and 18. This is likely to deliver a gross return of 3.5 times, which will set the private equity platform for much larger fundraisers in the future. The private wealth business managed an AUM of 74 billion, which was up 54% year on year. The RM base increased by 39% year on year. The platform now provides the complete suite of products on open architecture basis to cater to the entire wealth management needs of clients. Extensive training programs to enhance knowledge and service levels helped in delivering higher throughput from RMs and deepening of client wallet share and product penetration. Aspire loan book stood at 25 billion versus 5.6 billion a year ago. It has currently funded approximately 25,000 families till date. Aspire dispersed 4.8 billion in this quarter, up from 2 billion last year. It currently operates in 4 states and branch count has increased from 28 to 62 this year. It has credit lines from 23 banks and 1 NBFC, up from 8 a year ago. CRISIL and ICRA have awarded long-term rating of CRISIL A+ stable and ICRA AA- stable respectively. For this quarter on annualized basis, NIM was 380 bips, ROA was 3.5%, ROE was 16.6%, and debt equity was 5.7x. Gross NPL was 0.2% as of June 2016. The capital infusion as of June 2016 was Rs 4 billion. Every rupee in the net worth is now aimed towards 20% plus ROE opportunities and continue to run as a net debt-free parent company. Our investments in Motilal Oswal's mutual fund products stood at Rs 6.1 billion. The unrealized gain on these investments was Rs 1.8 billion. Track record of our QGLP investing philosophy across market cycles strengthens our belief in investment process. Our investments in Motilal Oswal's alternative investment products stands at Rs 1.9 billion. Proof of concept has been established with reference valuation of first growth capital fund at 3.5x. These commitments have not only helped seed these new businesses by investing in highly scalable opportunities, but they also represent resources available to use for future investments if required. To summarize this presentation, we believe that we have now 4 strong engines for delivering growth. Each of our businesses have established strong competitive positioning, and we believe that they have the potential to build tremendous scale and offer high operating leverage. We remain on course in creating a fair mix of capital market based, asset based and fund based businesses, which would help us deliver a sustainable 20% plus ROE. We thank you for joining us for this presentation video. A detailed presentation is uploaded in the investor relations sections on our website www.motilaloswalgroup.com.